Assalamualaikum. Today we shall continue with another topic, which is fraud and error. Okay, when we talk about fraud and error, there's one distinguished factor which differentiates between the two, and of course, we know that it is intention. While fraud is being performed with intention, error is considered as a mistake, where the person who did certain action or the mistake has no intention to do such thing. Okay, before we go to further slides, let us think about how is it something is being obtained illegally from someone, or can we rephrase it as why is it something is considered as fraud? First is because physically has been forced someone, let's say robbery, where it create a violent and traumatic experience and of course attract media attention. But when it comes to fraud, there's a trick involved and deception, where there could be falsification of document which misled the users or another party, and then degrading the confidence, so trickery has been involved. Sorry about that. And then let us look at what is the concealment of fraud. How is fraud being concealed? For example, falsification of document, forgery of signature or the content of the document. This is a very common in corporate world, where sometimes some people deceive another person by falsifying the document. Destruction of documentation, where these documentation have been shredded. On book frauds, manipulation of accounting records. For example, personal purchase has been debited as entertainment, issued shipping document for false purchases. There could be off-book frauds, misrepresentation of physical, commercial or personal realities. For example, purchases of goods of high price or price have been inflated, where it has actually include kickbacks. Okay, you have to go and look for the definition of kickbacks if you understand more what is it about. Concealment of fraud. Okay, fraud concealment will misstate the financial statement. So this is when stakeholders are concerned with, because when they rely on the information in the financial statement with certain misrepresentation or material misstatement, that could lead to wrong decision making. They purchase certain shares when they are actually buying the wrong company, for example. That we can see that with material misstatement, some of the information in the financial statement is not correct and is considered as deceitful to the owner. The owners here mean the shareholders of the company. There could be difference in amount or classification or presentation, omission or commission transaction and account. Remember, we talked about materiality concept. Omission is also one part of factor which may make information to be material. Disclosure perhaps not accordance to the accounting standard. Auditing International Standard 240 actually deals with fraud and error specifically. You can browse through the auditing standard, where they talk about definition and characteristics from paragraph 4 up to 12. And then they also outline the responsibilities of the management as well as auditors. And lastly, they talk about reporting responsibility. There are so many other discussion as well, but I confine my discussion only to this paragraph, because fraudulent financial reporting is only one part of topic 3. Now, just now we have talked about the difference between errors and fraud. Errors, again, I repeat, unintentional misstatement. For example, mistakes in gathering or processing data, or differences in the application of accounting standard, but fraud is definitely an intentional misstatement. We can categorize it as fraudulent financial reporting or misappropriation of assets. Example of fraudulent financial reporting could be manipulation, falsification or alteration of accounting records or supporting document, misrepresentation or intentional omission of transactions, while misappropriation of assets could be theft of asset itself, embezzling of cash receipts. So these are part of the examples of fraud. Now, moving on to still under fraud and error, let us look at what would be the responsibility. Who have the responsibility to cater fraud and error? Basically, both management and auditor contributes to better internal control as a medium to detect or prevent and correct fraud and error on a timely basis. But the main party would be the management. Management need to install effective accounting system, establish effective internal control system, establishing internal audit function or IAF, usually being short form, appointing audit committee, of course, for listed company. This is a compulsory requirement, and as well as establishing and implementing code of conduct among the employees and management. So the first party that need to tackle fraud or prevent fraud and error, or the first layer of defense, would be the management. Auditor came into the picture later. That's why we say auditor as incidental. So auditor will assist the management or the company by assessing the risk. After you assess the risk, we have discussed this in a previous class, we assess the risk and we design audit procedures. But in doing so, we have to maintain professional skepticism. We have to be, we must always remember that as auditor, we are not bloodhound, but we try as much as we can to be wary as the possible of fraud happening in the organization. And at the same time, we are not an insurer, because we cannot guarantee that the whole financial statement are free from material misstatement. Again, we go back to the previous class where we have talked about we perform our duty based on sample. So we can only provide the company or the stakeholders with reasonable assurance. Okay, Auditing Standard 240 also lists some examples of high-risk areas. For example, of course, if the company have a poor or not taken care of internal control, that could be indication of high-risk area or red flags, we call it in forensic accounting. Losses in inventory, unexceptionally large amount of expenses or purchases throughout the years compared to previous years, and most importantly, if management ignores whatever suggestions by internal or external auditors. So these are some of the things that we might want to consider when we are auditing the financial statement, looking at the management characteristics. For example, is the management being dominated by one person? Do they give us pressure to meet certain Does the management is being pressured to meet certain company's target? They have a high management turnover or poor management reputation in business. Again, these come by after many experience, so perhaps the audit partner will be aware of this situation. Another factor that we need to look at besides management characteristics is operating and industry characteristics. For example, the client company is less profitable than other companies in the same industry. How do you know this? Maybe from your readings, from your observation, from your inquiry with the management, looking at business index. There's so many ways for you to look at the information to understand the industry in which our client is in. Fluctuations in operating results as compared to the general economic conditions or declining industry pattern itself. For example, Like what we are experiencing now is COVID-19 very much affected, for example, tourism industry, so we expect there will be decline pattern. Okay, characteristics of the everyday engagement is another thing that we need to look at. For example, maybe the client's transactions and account balance are difficult to audit. This is the first time, or maybe there has been issues in previous audit engagement that the client have not been addressing, and we keep having the same problem during this year. Okay, let's say you have performed all the audit and you have come across certain indication of fraud and error. So the first and foremost, you need to obtain an understanding of the nature of the events and the circumstances in which it has occurred. So sufficient information is needed before we can actually make any decision or any conclusion about the situation. If we as auditor believes that the fraud and error could have material effect on financial statement as a whole, then appropriate modify or addition procedures need to be performed before we can actually issue any qualified report. We have to document our findings. This is very important to safeguard ourselves, and then we discuss with the management. We have to report to the management or board of directors or audit committee if we suspect there is any indication of fraud. Then only the last result, we will only issue qualified report with adverse or qualified opinion if there is a disagreement with management against. Recall what we have learned in audit report in AUD689. We will issue disclaimer if there is a limitation on the scope of audit work. Okay, interestingly, when we talk about fraud, we cannot run away from this theory initiated by Robert Cressy, actually a professor in Harvard, where he theorized about fraud diamond. So there are 4 factors which actually can lead to a fraud. First is incentive or pressure, which refers to the situation, oppressive condition of economic distress. Then we have opportunities. The person who wants to do the fraud have the opportunity to do so and hide their wrongdoings. Attitude refer to the characters of the person itself. Capability is the position in which the person who's doing the fraud actually allows the person to actually involve in fraud. Okay, these are the explanation. So if we say that when it comes to capability, just now I was saying that the person's position give leeway or give a way for this person to actually involve in fraud, where they use that opportunity and their position to actually perform fraud, as compared to person where they have the opportunity but they do not have the capability. Maybe the position does not allow him or her to do such thing. Okay, so when we talk about fraud diamond, we must also make sure that another party that really needs to beware of any fraud in the organization would be the board of directors. So this is what we are going to address in next slide, which is the corporate governance. You have learned this in CRG 650, but I would like you to see corporate governance from the context of audit committee and how internal auditor can assist. Internal auditor or external auditor can assist the management to counter the fraud activities in the organization. If you have any question, you can ask me in the next slide. In the next class. So with that, thank you. Assalamualaikum.